Okay, time now to focus on where the market ahead lies. And we're not talking about just the tactical move or the very near term, but we're talking about how somewhat 2081 is going to actually pan out. And who better than Ravi Dharamshi himself, CIO at ValueQuest Investment Advisors, right here in the studio to throw some more light on that. Ravi, firstly, a very happy Diwali.
Happy Diwali to you as well.
You and your entire team.
Happy Diwali to you and all the viewers of ET Now.
Yeah, thank you so much. So Ravi, how's it feeling like? Well, the year of course has been great, but I think this Diwali week or the month could have been a little better, I guess.
Yeah, I see we can't complain. We've been having 3 fantastic years. So on back of that, if a little bit correction is there, I think that's par for the course. What I would say broadly what is happening is that government is continuing on the fiscal discipline path, and RBI is keeping the liquidity tight and the monetary policy tight as well. So both these things are leading to some amount of a slowdown, and we can see that in the high frequency indicators that the numbers are slowing down, especially on the consumption side. So some amount of change in stance is required either from RBI or from the government to start giving a little bit boost. But I guess there is some uncertainty surrounding US election and what the Fed is going to do. Maybe some action will happen after that, post that. And but I do believe that all these are near-term concerns related to consumption specifically. Rest of the economy is not doing that badly, especially the capital goods oriented sectors.
So would you say this correction is going to be fairly shallow, and what's the expectation then for the summer 2081 in terms of returns? Because last 3 years, as you pointed out, has been much ahead of average. We have seen 19-20% kind of returns from Nifty itself versus average of 12 to 14%.
No, so because of just the sheer magnitude of the returns, we should temper our expectation in terms of what kind of returns we should expect. And we don't talk in terms of 12 months, we talk in terms of 3 to 5 years. Can we still get double-digit returns from the market? I would say definitely possible. If you are smart enough and can generate alpha, you can do slightly better than that as well. But definitely should not have expectations more than that. Some volatility is to be expected, and we should be trying to take advantage of that volatility rather than getting scared of it. Shallow in terms of correction, I think we have already corrected some 8-10% from the peak. Can it correct another 5-7-10%? I cannot rule it out, just because we have the kind of returns we have had, and the valuations are a little on the expensive side. So with the slowdown and with the kind of valuations we are seeing, it's absolutely par for the course. So from the peak to correct around 15% kinds is, I would say. But beyond that, I would say then they start looking attractive again from a 3 to 5 years perspective, because none of the problems are really balance sheet oriented problems. They are all more P&L related problems and more valuation issues.
But talking about that, Ravi, don't you feel that the selling around the earnings disappointment has been kind of a little too brutal? And if it is justified then, and if earnings were to slow down in some of those sectors, consumption, banks, etc., do you sense further EPS cuts coming in?
No, I think definitely this festive season was supposed to be the one where a lot of revival was, people were banking on the revival. And that does not seem to be panning out. The first 15 days of October are not pointing to a very, very strong festive season. So from that perspective, I don't rule out further EPS cuts. And as we keep talking, it's essentially more focused on the consumption side. And as I said, the macro reason is government is being more disciplined on the fiscal side, and RBI is being more tight on the liquidity side. Those are the primary reasons. And the trickle down that we are supposed to see from the corporate earnings, from the corporates doing well all the way to the economy, that takes a little longer. That thrust is not yet there in the economy for the populace at large to start doing well. My sense is this stance will change, and it should change in the next 12 months, where in fact, I am already seeing that the central government might remain fiscally disciplined, but the state governments have already started treading on the path of giving welfare and everything. So that should give boost to consumption, but probably there is some time lag before that starts to happen.
You'll have the state elections as well.
Yeah.
So yeah.
So given the fact you are expecting a pickup in consumption, wouldn't now be the right time to buy those dips and buy the correction, if at all, if they are correcting on earnings?
I agree with you, but when you say right time, it's not necessarily next 15 days, but over the next 2, 3, 4 quarters, would be the right time to look at it, because all the disappointment is getting factored in. And if you take a 3-5 year view, one has to see that actually the stars are starting to align, that all this consumption hockey stick growth that we've been waiting for might finally come through. If you see NDA 2 government in its first 5 years focused on only creating a safety net and getting the systems in place. Second 5 years they focused on trying to revive the cycle with corporate profitability. And this one, I believe, should ideally lead to some amount of focus. And in the budget also, we have seen that they are trying to revive the real estate cycle and jobs growth. So jobs growth, wages growth, if they come through and the real estate cycle revives, that should lead to consumption boom as well eventually. But consumption is a lagging indicator. First, the real estate cycle at the bottom of the pyramid needs to start doing well as well.
But you know, Ravi, the other thesis is that if you're a longer term investor, which all of us hope to do, why even look at these tactical and cyclical themes, right? You've always been a big propagator of the energy transition theme. Why not play these 10, 20-year kind of stories? Real estate, yes, being one of them, and then financials, whichever way you want to, you know, cash in on the India growth story.
No, see, all businesses have cycle. It's not like any business is cycle proof. But the difference being, some cycles are 1-2 year cycle, and some
what
cycles
I meant is don't bet on
5-10
the shorter ones.
So if you are betting only on something that's going to last 1-2 years, you'll have to know exactly when to enter and exactly when to exit.
Exactly.
Which is very difficult to do. Yeah. So for that perspective, you need something that lasts 10-15 years, and then you can try and capture a 5-7 year period out of that cycle. Because, and usually, even if the trend lasts longer, markets tend to capture that very, very quickly. For example, defense theme for all practical purpose started in 2019-20, and by 24 we have kind of already factored a lot of the future in. So if the,
and I think it's only in late 2022 when, you know, retail and
correct,
you know, mega participation really
yeah,
came
so
in.
that's how it happens.
Yeah.
A theme becomes more popular, more participation comes in, sector funds get launched, and that tends to basically capture a lot more of the future gains much earlier. So even a 10-year theme, from the perspective, the sector might continue doing well, but from the stock market's point of view, the gains get captured very quickly.
So are you completely out of defense then?
Yes, for the moment we are.
Okay. And yes, getting priced in is something that we have seen with the case with Vari Energies as well, the kind of listing it got and everything, because people are trying to bank on those stories. But talking about the financials a bit more, because again, it's a very large sector with respect to PSUs and privates and insurance and brokerages and whatnot. What's the pecking order within all of that?
See, financials, of course, you split it into two buckets, lending and non-lending financials. On the lending financial sides, essentially the two plays. What I said, that over the next 12 months, these central government driven capex cycle will pass on the baton to private sector driven capex cycle. Because finally government has left the elbow space for the rates to come down. Government is trying to stick to the fiscal discipline, and their ability to push the envelope has kind of reached a limit. So private sector needs to pick up the baton over there. But what is happening is a lot of this capex is actually getting funded through equity rather than through debt. So we need to see that confidence coming back for the corporates to start taking leverage for the future projects. That re-leveraging of the cycle should begin from this year onwards is our bet. So from that perspective, the large corporate lenders should do well. Second big change that we are expecting is that in the real estate cycle, instead of only the top of the pyramid doing well, we'll see more broadening of the base where even the bottom of the pyramid cycle does well. For that, I mean, the focus in the budget was very clear on that. So, and if and when that happens, I think the affordable housing segment, affordable housing finance segment should also do well. And there are some quality plays available over there. So these are two segments on the lending side that we like, and then there are small businesses focused lenders that are doing well. So these are the three segments within lending that we like. On the non-lending side, we like wealth management, or rather the capital market beneficiaries. I think capital markets last 3 years have done well, and the numbers are there. The kind of flows mutual funds are getting, all that is getting baked in. But we believe this is not the end of the story. This feels like this is going to have a long runway. We are still at about unique around 9-10 crore kind of demat accounts. I think that number has to swell to 20-25 crore by the turn of this decade, and that will mean the sustained growth. So there will be a lot more beneficiaries coming out of this sector, capital markets place. We like wealth managers, but there are other plays like exchanges, brokers, discount brokers, market infra companies. Those are all reporting good numbers. That should do well. We do like insurance as well. Insurance has had a bad 5 year. Of course, last 6 months have been good, especially on the general insurance side, because the competitive intensity has finally abated. So during the the heydays of private equity, when money was available freely, some of the unlisted player were basically engaging in market share grab and leading to competition which was quite a little irrational. So that eroded the margins. Now the valuations also corrected and the margins also bottomed. Since last 2 quarters, the listed space leaders have started doing well, precisely because the auto cycle also turned and competitive pressure also decreased. So that makes us bullish on the general insurance from here as well. And you can say that also is kind of a play on this wealth generation, because not general insurance, but businesses tend to do well, they take insurance. The individuals tend to do well, they also tend to take insurance. So life insurance is actually sold as an investment product and not as a term product in India. So that also is essentially a quasi play on the capital markets boom.
Yeah, but just a follow up there. How are you pricing in the regulatory risk and all of that? And I ask you that because, for instance, when it comes to the capital markets, there are those measures which are expected to come in on derivatives, which is expected to curb that a bit. RBI has been very vigilant, so you don't know which day you will get a notice on which NBFC or which bank of late. So how are you pricing all of that in?
No, so I'm glad you brought that up. It is absolutely a must and a required, because we don't want a systemic issue. We definitely, all these measures tend to lead to a short-term kind of a impact on the volume numbers, and usually for brokers and exchanges more on the market side. But eventually what this does is it brings in entry barriers for the smaller guys, and that means that the market share from them tends to get consolidated towards the larger guys, those who can comply with the regulations much easily. So that is from a stock market investor point of view, you have to ensure that you are aligned with the guys with the best corporate practices and strongest balance sheet. But this might lead to a short-term disruption, but it is good in the long run, and especially for the larger guys. Similarly, I mean, for the all regulators, whether it is RBI, IRDAI or SEBI, all these actions lead to the smaller guys feeling the pinch because they have to comply far more, and the larger guys manage to do that, and that leads to them getting more and more market share.
Ravi, you talked about as to how it's not just the premium end of the economy when it comes to consumption, but a more broad-based, top-to-bottom kind of approach that you would now be looking at. How does that tie in with real estate? Because up until now, you've only seen the premium end of luxury, that to residential and commercial, both real estate do well.
So see, post-COVID, unfortunately the recovery has been as it's popular now, K-shaped.
K-shaped, yeah.
And what that meant is that anybody who owned an asset has done well. Whether you owned equity, whether you owned gold, or whether you owned real estate, you did well. But if you have been only a wage earner, income earner, then inflation has been beating your growth in your earnings, and your discretionary power has gone down. Now the focus is very, very clear. If you need maximum bang for the buck, see, if I read between the lines, this government is very keen on ensuring that there is a sustained boom without inflation rising. So they have been stopping themselves from giving any kind of a demand stimulus and focusing only on the supply side reforms. Now, with that kind of a constraint, if you still want to see a boom in the economy, then the maximum multiplier effect you can generate is through the real estate. So the boom has started at the top, but now it will percolate down as well. You can see the top cities and the premium projects doing well for the last 2-3 years, but now it is starting to percolate. As companies hire more, as jobs get generated, everybody wants to have a better place to live, better lifestyle, and this is a big kind of a capex even for an individual. So the third component of the capex cycle is the household capex, and in household capex is primarily real estate. That's the biggest capex that anybody will do. So those two places are where the government is focused. In the capex, 20% is central government, 40 odd percent is private sector, and another 40% is the household. So these two 80% which form the largest part of the capex cycle, it is very important for government to try and revive that, and they are focusing on that. So my bet is there could be a lag of 12 months or 18 months, but there is no doubt that this government has sharp laser focused on reviving these two sectors, and we should be betting on that. We'll see how it pans out. But we can play through the affordable housing finance companies is one way. Second way to play it is through building material companies, because see, all the projects that were launched 2-3 years back and have now finally getting completed. We'll see, you know, everybody is probably making their houses, interiors are getting built, and that's where you go and buy everything that goes inside a house. So that the next leg of the cycle is beginning now.
Interesting, but the other sort of capex that a household does, and that perhaps comes even before a house, is autos, right? Whether it's two-wheeler or four-wheeler. Do you think that upside is already captured in the last 3-4 years, or it's still to go? Because I think that's the sector where the debate is still open, whether the sector is expected to do well from here on, or it's peaked.
No, so autos are facing a different kind of a challenge, honestly. You are right, that is the other big discretionary consumption item in the portfolio, and essentially they have converted it into OPEX with everything going from your EMI. It's not a one-time big thing. However, autos are facing the challenge from one, supply, lack of launches. Third, EV, we don't know, the regulations are still evolving. So on the back of couple of good years, and the penetration levels are also pretty high for a sector like two-wheelers. It is not possible to imagine a sustained double-digit growth for a very long period of time, because now I would say nearly 35-40% of the population owns it. So and we need infrastructure to keep pace, right? And a city like Bombay cannot absorb more and more cars. So we need to first have that infrastructure in place before we can have a sustained growth. And I think government's focus has also been to try and create the public infrastructure. Public transport would be the way to focus on improving the lives of more people rather than them spending on car. I mean, as the saying goes, or the way it is in the developed countries, the sign of development is not that people have bigger and larger cars, but that even the rich people travel through public transport.
Like a Singapore.
So, exactly. Yeah. So you want to not actually have more and more cars, but you want better infrastructure so that movement can happen much freely.
So it's an underweight on autos for now.
Yes, for now, yes.
So autos underweight, defense underweight currently. What else to avoid?
So any sector focused on, or rather dependent on, the central government capex, which is defense and railway. See, I'm betting on
power, because that also is largely dependent on that.
It's dependent on government policies. Government is not spending. The spending over here is done by NTPC and power grids, and and they don't have any kind of an issue. So government is only planning what projects to implement. They are not spending from their balance sheet. So from that perspective, power is a little is not dependent on the central government capex. While these are direct items, defense and railways both. So from that perspective, I feel that those are the two segments where you can feel a little bit of pinch, and one should stay away. Also, as we have just seen in case of one particular defense companies, that the foreign partner did not supply the required engines, and those kind of execution delays, time delays, material cost variance can lead to a lot of issue. And now the valuations are not that attractive. Any disappointment, as you are saying in this particular quarter, a slight disappointment, and the reactions are tending to be more brutal. So that will be the case because the valuations are on the higher side.
What about some of these niche pharma and specialty plays? Because specialty chemicals, I mean, it's been a couple of quarters that we have been talking about the end in sight and things are likely to look up, but the earnings still haven't given you that much confidence. Are you getting more confident about it?
So See, earlier pharma used to be a much more homogeneous sector where you could bet on a revival in US pharma space where the generic pricing goes up, and most of the companies in the sector used to do well. But now over a period of time it's become more and more heterogeneous. You have to figure out what is going to do well. Are the oral solids going to do well? Are the biologics going to do well? Is the CDMO going to do well? Are we talking about diagnostics, hospitals? Which segment in the pharma are you talking about doing well? Domestic pharma is a branded generic play that has been doing well, but the valuations are also reflecting the same. So from that perspective, I think we have to still find our niches where we believe that the tailwinds are still very strong and the valuations are not capturing all of it. So definitely CDMO is one space where a big opportunity is opening up right now. Only thing is we are unable to judge at this point of time what the timeline could be, because the Biosecure Act in US has left a window of 7-8 years for the Chinese companies to continue supplying. And if there is going to be any further dilution, then that remains a risk. But otherwise, from a pure commercial and economical sense, it makes all the sense for the companies in US to start diversifying their global supply chain. So in a way, this is also a China plus one play. And where there are companies, there will 4 or 5 companies will emerge out of this country that will do well over a 10-year horizon, where we will have our own version of Wuxi and Samsung Biologics kind of companies being born in India. Another space which is the most exciting within pharma is the weight loss drugs category, right? That is a big thing that has happened in the last 3-4 years, and it is still growing. That has become a $20-25 billion market, and it can become a $100 billion market by the turn of this decade. So $100 billion market eventually will flow into Indian markets and the other markets as well. Right now they are patent protected. But these are the two areas where I feel there is a tailwind developing. We are at this point of time slightly unable to gauge when those tailwinds actually start converting into numbers, and which are the players that can actually benefit out of it. But that is okay. That is about stock picking. But overall, those are the places to be in pharma.
Talking about tailwinds, what about the structural headwinds? I mean, to my mind, what really stood out was Avenue Supermart saying that QCOM is a big disruptor for them. So either they change their ways, or then, I don't know, the business perishes.
No, I think even we could not understand the impact of 10-minute delivery. We were wondering why it is needed, but I guess there is clearly a need, and players have realized a little later, and they will course correct for sure. But I think the leadership is kind of set over here. It will be difficult for somebody else to come in. There are 3-4 players. It's not only one player, but yeah, the incumbents will have to change their strategy and try and counter this quick commerce. It's a big trend that is definitely playing out in the consumption space.
So Swiggy, Zomato, core portfolio buys at whatever levels?
No, I will not comment on any specific companies, and I can say that we have also missed out on identifying this trend. Overall consumption basket is slowing down, but this is the only piece that is growing and doing well. And valuations prevent us from taking a new bet at this point of time.
It's okay to miss out one of the trends because you've caught on some of the mega trends or the...
Can't have it all.
Exactly, for the next decade. But if not 3 to 5 years, not 10 years, but if you have to give one tactical trade for the next summer, 2081 for our viewers, what do you think is the best asset class or the best sector or the best stock for the next 1 year?
No, so again, you might say 1 year, but because I don't look at it from that perspective, I won't know. But I do continue to believe renewables as a space is going to do well, and the story has just begun. In the March of 24 is finally where the ALM came into effect, and now the domestic market is witnessing a big boom, and I think this will continue for a 3, 4, 5 year period. There are and usually when there is a S-curve kind of an adoption in any sector, valuations seem optically expensive, but when you roll it down 3, 4, 5 years, you realize that the pace of growth was far, far higher. The concerns over there obviously remain that the prices tend to fall as well. It is not just that volumes will grow, but the prices will fall. The companies that will be able to manage to grow despite the falling prices and manage margins despite that will be the ones that will do well. So without naming any company, I think renewables is the place to be.
Okay, Ravi, great to have you in the studios. Wish you a very happy and healthy and prosperous Diwali once again from all
Thank you
of
so
us.
much. Thank you.
Thank you. Okay, let's just revisit what the market.
If you like this video, then like, share and subscribe to ET Now.